Now onto a bond market moment with Todd Colvin of MarkIV Brokerage. Todd, what do you see happening in the bond market ahead of that Fed interest rate news coming out on Wednesday?
FOMC is finally here, or at least it'll be here tomorrow. September FOMC has seen a wide map of expectations, from a 25 basis point rate cut to a possible 50 basis point rate cut to possibly no rate cuts. Well, as of last Friday's close, expectations were for a 25 basis point rate cut. That is pretty much a lock. Ultimately, we could see something different. There are very small odds of that. So we get our 25 basis point rate cut, and then what? Well, then comes the all-important press conference when the Fed will likely lay out, or Powell will likely lay out, his forward guidance, size, and frequency of future cuts. Because right now, one cut is not only priced, we've got 3 cuts priced between now and January, and then an additional 2 cuts priced into the middle of 2026. That's 125 basis points of cuts, and that could also change if the labor market continues to weaken. How will the bond market be affected? Well, any big cuts will send those inflation expectations higher, and that will hurt the bond market. At least will prevent yields from going down. And that's kind of one of the reasons why the Fed wants to cut rates, is to make housing more affordable. And the only way to do that is to make mortgages more affordable. And right now, mortgages are not. So they want to keep the bond market happy. They want yields to go lower. They have to do a slow and steady rate cut process. And that's likely what we'll see. At least that's what they'll talk about. They're going to have to walk a very fine tightrope here. They don't want to get too far ahead of themselves. Likewise, they don't want the bond market to read too much in to what they're saying. So they'll keep it direct, but they'll probably keep it a little bit vague as far as their forward guidance. We all know the labor market's weak. We all know inflation is remaining stubbornly high. But how do the two work together to bring rates lower? That's going to be what the Fed has to figure out. So look for the bond market to not see a big move lower in yields. I mean, the 10-year's at 4% already. Will it dip below? It's unlikely that we'll see a big move lower. Market's going to want to wait and process how some of the growth figures are going to come in down the road, as well as the labor market. So keep an eye on those 10 years. If we do see a move below 4%, look for that 385 low. That's the year-to-date low as an extreme at this point. Ultimately, though, moving back higher, 420 is really going to be your first real resistance on the upside. So keep an eye on the bond market. We're hovering right here, 4% in the 10-year note yields. It'll be listening more than it will be moving, and obviously we'll see the move in the days and months after.